The trader's three choices. Let's take a look at the text in your book, in your manual, page 69. Each time a Forex trader sits down to place a trade, they are faced with three simple choices: to buy, sell, or to wait. The first step, a fundamental analysis, should reduce those options to just two possibilities. The next objective is to eliminate one of the remaining choices, process of elimination, so that a single, logical, non-emotional, high-probability trading decision has been reached. In the 1930s, the price movement of the U.S. stock market was compared to the movement of the ocean on a beach. There is a tide, there are waves, and there are ripples. We've talked about this before. We've actually compared this to the size of movements. This can be compared to the size of movements. Some traders look at it that way. Other traders look at it as the direction. The text goes on to say, this mental image allows a trader to visualize the purpose of this three-step trading process. The first step in fundamental analysis and the first step in technical analysis is to establish the direction of the tide. Professional traders always trade with the tide. I'm going to get rid of that word tide because we referred to it earlier more as a size movement analogy, and I'm going to use the word trend. That should be a more familiar word to you. Professional traders always trade with the trend. You can go ahead and cross that word tide out of your book. A trend is what we are looking for. Professional traders always trade with the trend. That is easier to remember. The second step in technical analysis is to establish a wave pattern. Like the sights of a rifle, the rear sight must align with the front sight, and the front sight must align with the target, or the shot will fail. Professional traders ignore the ripples, the little itty-bitty movements, the insignificant occurrences in the market. Professional traders ignore those, and they know that they are not part of the tide or the trend as we called it a moment ago. As far as establishing a wave pattern, professional traders can look at charts and see the patterns that have been consistently repetitive, and that's what we mean by that. To see that on average this is completely random, a completely random example, but hopefully it will help you understand. The professional trader can see that on average the yen goes up the first 3 days of the month, every month, and then comes back down, retraces halfway. That is not a fact, just an example of a wave or pattern that a technical trader would notice over time and ultimately take advantage of. So those are the three choices of every trader. Remember, we can always buy, sell, or wait. The point of fundamental analysis is to eliminate one of those choices so that we only have two. Because we know that overall the dollar is headed down, technical analysis should help us eliminate one of the other two options. If the dollar is headed down, then we are looking for a selling point that we can sell, get into the market on a sell. And our technical analysis is either going to tell us yes, now is a good time to sell, or no, I am going to take my third option and I'm going to wait. So fundamental analysis is going to tell us the market is heading down. Technical is going to tell us whether to sell or wait. Or if fundamental tells us the market is heading up, then technical is going to help us decide whether to buy or to wait. Remember, traders' three choices, right along with mental filters and trading psychology: buy, sell, or wait. No emotion. This might be one of the single most important aspects of trading Forex. Page 104 of your text. Psychologists tell us that irrational behavior increases in a person when they feel that they are under pressure. This applies to Forex traders as well. Maybe more so than any other example is that of the stressed out Forex trader who feels that he has to overcompensate for bad trades. He becomes emotionally involved and who has irrational behavior because of his increased level of pressure and stress. This is something that we must learn to avoid. Experienced traders around the world will tell you that the hard times that they have run by have not been a result of bad decisions or just incorrect analysis, but the result of bad decisions related to emotion. The time when within 48 hours they got behind in their account, they made ridiculous trades to try to catch up. They tried to play the game of catch up where they tried to save an original bad trade. Oftentimes traders will increase their lot sizes hoping to make up for a previous loss. This is just simply irrational. You cannot trade your way out of a hole. If you ever find yourself desiring to do so, if you have lost 30 pips on the day and you want that money back and you say to yourself, well, I can get it back, I can trade myself out of this hole, if that thought ever comes into your mind, get away from your computer, step away from the trade. You're being irrational. You have lost the ability to make a logical trade, and it happens to the best of us. It is just something that you want to be aware of. Keep emotion out of your trading. Don't make the mistake of telling yourself that it will turn around. It is at the bottom. It has to come back. Remember, I've said this before. It doesn't seem that I can say it enough. It doesn't have to do anything. It doesn't have to do anything. Don't get caught up in the foolish assumption that it has to turn around and that you will eventually make your money back. You might just lose the farm if that is your logic. Most Forex traders that have been in this situation will be the first to admit that had they only followed rules of good money management, kept the emotion out when they lost, that loss that really hurt the most, the 40 pip loss, had they just cut their losses, stepped away from the computer, and been done for that day, they would likely still be trading Forex today. It is those traders that have a bad day and their technical analysis is wrong, they lose those 40 pips, and then they stay up all night trying to make it back until their account is diminished. You can stay in the market for at least a year if you always follow the 2% rule that we are going to be talking about a little bit later, and limit your losses. There is no reason that you cannot stay in this market long enough to learn it well enough to succeed. Some traders, as with anything in life, some traders pick up this skill quickly, other traders struggle along for a longer period of time. It takes them longer to learn, but I will tell you one thing, we can all master this market. But as soon as we get greedy and we start letting emotion become involved and we don't use rules of money management, risk to reward ratios, we will not stay in the market long enough to learn it and succeed. I really like this last little section, this text in your book, page 104. Any Forex trader who allows themselves to go even 1 pip beyond their predetermined exit point cannot call themselves a professional. 1 pip, just 1 pip, and you are no longer a professional. By doing so, they have allowed themselves to get caught up in the emotion of the trade, and it is bad business. You always have to treat your Forex trading like a business. Remember, no emotion is just a mental filter that you are keenly aware of. And for some of us it is difficult. If you begin to find yourself emotionally involved in the market, take a step back and rethink your strategy. Get your head straight. There are those that just can't trade Forex. Emotion will always be a part of everything that they do. If you find that that is you and you just can't seem to break out of that pattern of being emotionally involved, take a step back, look to maybe some managed accounts and auto-executing software that will help you implement some strategies, but step away from the computer at the same time. There are always still ways to take advantage of Forex. I really wish that I could tell you that an emotionally involved trader could become a successful trader, but no, they are not a trader, they are a gambler, so we have got to find a way to keep that emotion out of our trading.